Спасибо. Спасибо огромное. А теперь прозвучит новая песня. Примеры.
YouTube challenge today. I'm going to show you over the next 25 minutes everything that I know about the forex market so that you can make an informed decision whether it's something you want to delve deeper into. Now, joking aside, there is so much to know when it comes to trading in general, or indeed the forex market. So what this is intended to do is to basically skim over some of these topics. I'm going to skim over the most important topics. If you want more information, of course, you can subscribe to the channel and get all the other information in there that I put out on the channel. I've covered a lot of these topics in much more detail on the channel here, and also, of course, in our trading room as well, should you wish to come over there. But basically, this is just like a quick summary of everything you need to know. And here are the topics that I want to cover with you today. So the what, the why, and the where. Why are we trading the forex market? What are forex pairs? Often people ask me, what is a forex pair? Lots and leverage. We're going to demystify the forex price quote, sometimes a bit confusing for some people. Technical analysis versus fundamental analysis. We're going to look at brokers and the different trading platforms you can use. In particular, I want to show you the MT4, the MT5 trading platform. That's the platform that most beginner traders use these days. Then we'll look at the forex price chart, what the forex price actually looks like on a chart, how to read them and so forth. We'll look at the different order types, different strategies that you can use. Strategies, basically a set of rules that will allow you to enter and exit trades. We'll look at the risk management, the psychology tips and challenges. Psychology, one of the most biggest and most important topics of the whole of the trading game. We'll talk about copy trading and signal following. Is it really worthwhile? Will you make money by following signals and copying other people's trading? And then we'll wrap it all up at the end, so then you can make that decision whether you want to continue. Of course, if there are any of the topics here that you want to delve deeper into, as I say, check out the YouTube video. I suggest you watch this video now in its entirety, then watch it again and pause if you want to take notes, because I say we are going to run through it. It's going to be at super fast speed. So what is the forex market? Well, you may have heard this before. Forex market is the largest financial market in the world today. It has a turnover of almost $6.5 trillion. You see what's happened basically in the last 30 years or so. The growth has been pretty explosive, and it's growing each and every year as well, certainly dwarfing any of the other markets. The next nearest market to that is indeed the stock market, which doesn't even come close. So what is the forex market? Well, in a nutshell, forex trading is basically the buying of one currency and the selling of another currency. Now, if you think a particular economy is going to do well in the future, or in the next hour, or whatever it is, and you might think that currency will do well as well, then you buy that currency. But when you're buying a currency, you're exchanging it for another currency. So you may be picking a currency that isn't looking so positive in terms of its economy and its outlook. So basically, the forex market is buying one currency and is selling another. Unlike if you're buying stocks, you're just basically buying the stock or commodity. You're just basically buying one entity. Forex has two transactions going on at any one time. Now, the chances are you've already traded the forex market without even knowing it. Now, imagine you want to go on holiday, which I'm sure if you do, you want to change up your currency. You change up your currency if you're going overseas to the currency in which you are traveling to. I live here in the UK. If I want to go to the Big Apple in the USA, I've got to change my pounds for the US dollar in order to facilitate my holiday, my spending. So here I am in the UK, and I want to take £1,000 with me on holiday. So I go to the Bureau de Change, you see them there at the airport, all the prices on the board flickering away, they're changing. They're changing instantly throughout the trading day. They're changing 5 days a week, 24 hours a day. These prices are flickering and changing. At the moment, I'm changing up and I see the exchange rate on the board, it's 1.3. So my $1,000 buys my £1,000, I should say, buys $1,300, $1,300. Now, let's assume that the holiday doesn't take place. let's assume, say, the pilots go on strike, or let's assume there's a global pandemic and all the flights have been cancelled. I'm sitting here with all these dollars in the UK. I've got nothing to do with them. Can't spend them here in the UK. I've got to change them back into pounds so I can carry on spending my money. But now the exchange rate has changed. Let's assume the exchange rate has changed from 1.3 to 1.2. Exchange rates are changing, as I say, all the time on the money markets. So now my $1,300 that I'm owning, I've got to buy pounds back, and I buy them back at the prevailing exchange rate, 1.2. So if I divide 1,300 by 1.2, I get 1,083 pounds. So basically, I have made an £83 profit for doing absolutely nothing, purely because the exchange rate has shifted from 1.3 to 1.2. That's the basics behind an FX transaction, a foreign exchange transaction. Slightly different when we're coming to trading it, but that is the basic premise behind Forex. So why the Forex market? First up, ease of access. Forex market is basically decentralized. It means there's no central marketplace. Basically, it's a communication network with all the banks and brokers all putting in their price feeds. And us as retail traders have easy access to this market via brokers. As long as you've got an internet connection, you can use this with a laptop or a smartphone. You can trade from the beach. You often hear people say trading from the beach. I think if you're sitting on the beach, you shouldn't be trading the Forex market. There's plenty of other things you should be doing, but you get the idea. As long as you've got an internet connection, accessing the Forex market these days is indeed very, very easy. And liquidity. I mentioned to you a moment ago about the liquidity. It's a vastly growing market, $6.5 trillion a day. That basically means it's very easy to enter and exit the market. Obviously, the more easy it is, the cheaper it becomes as well. So the liquidity really does assist the retail trader. Cost of entry basically is affected by increased liquidity. More liquidity, cheaper it is. Transaction costs, as I said, very low commissions now. A lot of the brokers are fighting for your business. They want to take your business and they offer very, very low commissions. It's a very competitive market, and the spread between certain currency pairs, more about this in a minute, sometimes can be very, very close. The difference between the buying price and the selling price, very tight. That basically means that the cost of doing business in the Forex market is considerably less than other trading entities. And leverage. Remember I showed you there that example of going on holiday with your £1,000 and you change them into dollars and you make 83 pounds. Well, clearly you're not going to be giving up your day job with 83 pounds profit. But with the Forex market, many brokers will offer you high leverage, basically lending you money to trade the market. So basically, if you have an idea of where you think a currency market is going, currency pair is going, you can use broker leverage to make those gains bigger. Leverage is a double-edged sword. More about that later. Leverage can offer huge returns, but also can kill you as well unless you know how to use it correctly and use it wisely. Trading hours. Forex market is open 24 hours a day, 5.5 days a week, just because it's open 24 hours a day, 5.5 days a week. It doesn't mean you should be trading 24 hours a day. Leads to fatigue, leads to problems, leads to certain nasty habits as well sometimes. But it certainly suits those that are on shift work, people that have day jobs, people that are able to spend a few hours a day in front of the screen. So basically it's accessible, unlike a normal stock market that will open at 8 AM and close at 4. Forex market is open all day long, 5.5 days. Very easy for you to do this alongside your day job as well. Okay, so the Forex currency pairs that traded in the Forex market. Now, there are typically 8 major currencies that we trade in the Forex market. Now, of course, you can trade all the other currencies as well, the Hong Kong dollars and the Singapore dollars and Norwegian and what have you. But the major currencies that are quoted in the Forex market these days are these major 8. Australian dollar, pound, yen, euro. You can see them here on the board. So when you cross-match all these different currency pairs, you have a total of 28 different currency pairs that you can trade. So you can trade the pound against the Aussie, pound against the yen. So it's basically 28 different currencies. So there's plenty of opportunity for you to get into a strong currency against a weak currency. Plenty of opportunities. If nothing's going on in the euro against the pound, no problem. There might be something going on against the New Zealand against the Swiss. Plenty of opportunities. A little bit more about the Forex pairs now. Basically, they're split between majors and minors. Now, the majors are currency pairs that basically trade against the US dollar. Now, the US dollar is the most actively traded currency on the planet. I think the last time I checked, it basically accounts for about 88% of all foreign exchange transactions have the dollar on one side. So these other 7 currencies against the US dollar are known as the majors. Now, the benefit of trading the majors, because they're most actively traded, is that the volume and liquidity is much greater. So sometimes volume and liquidity might dry up in the less actively traded currency pairs. Against the majors, they have the most volume and the most liquidity because they are the most actively traded. And that basically means you get tighter spreads. The difference between the buying price and the selling price, that is a cost in trading. If you're buying a stock for $5 and then the bid price is $4, well, the cost of entry on that is $1. So the more actively traded currency pair, the majors, the tighter the spread, the less cost it is to trade. So the cost of trading the majors is less. Conversely, if you're trading the minors, all the other currency pairs, cost of business is generally more expensive. These are less actively traded, although there are some major opportunities in these as well. The volume and liquidity is less. Okay, the spreads can be wider. If you're trading perhaps maybe the New Zealand dollar against the Swiss franc, something like that, sometimes the spreads will widen in that because it's not so actively traded. So it's fair to say the cost of trading of the minors, everything that doesn't have the US dollar on one side, is generally more expensive. Now I want to talk to you about the Forex price quote. So here is a typical price quote. Here you've got the GBP versus the USD. This is the Great British Pound versus the US dollar, 132.50. Now, the first currency in the quote is known as the base currency. The second currency in the quote is known as the quote currency. Don't worry too much about that at this juncture. But the first currency is the base, second is the quote. Now, if you're buying the pound US dollar, it means you're buying the pound and you're selling the US dollar. So whatever you're doing to the currency pair, you're doing basically to the first currency. So if you're buying the pound dollar, it means you're buying that currency and you're exchanging it for that currency there. And the quote currency tells us how much of this currency, the US dollar, is needed to buy one of the base currency. I know this sounds a bit confusing. It will become a lot clearer when you actually look at the prices on a chart. So for example, in this example, the buyer has to pay $1.3250 to buy £1. If you're selling a particular currency pair, you're selling the first currency. In this case, you'll be selling the pound and you'll be buying the US dollar. So remember, whatever you're doing to the currency pair, you're doing predominantly to the first currency. So you're selling the pound, buying the US dollar. And the quote currency tells us how much of this currency you will receive for every unit of the base currency that is sold. In this case, the seller will receive $1.3250 for every pound that he exchanges. So what you really need to know, this is all a bit confusing, but what you really need to know is how much is all this worth? How do you calculate what the value is of this? So basically, let's have a look at what a pip value is worth. Bearing in mind this quote base currency, let's assume here the bid and ask, that's the difference between the buying price and the selling price. Here you see 145.25 to 145.26. The asking price, as always, is going to be higher than the bid price. Let's exchange now. $100,000 at the ask price, it would give you $145,260. This is for one standard contract. In Forex, we talk in terms of contracts. One standard contract is 100,000. I'll talk more about that in a second. The bid currency here is at bid price is 145.25. So 100,000 at 145.25 would equate to 145,250. So you can see here the difference between this is basically $10. That's all you really need to know. Don't worry too much about all that stuff I mentioned. All you need to know is one standard contract, the difference between 25 and 26 is one pip, equate to $10. How you work the calculation now is you simply divide 100,000 by 0.0001, gives you the $10. That basically shows you what a pip is worth. So all you need to really know is this, that when you're trading in Forex, we trade in terms of lots. Now, a standard lot, as I mentioned a moment ago,